Welcome to an introduction to accounting, brought to you by Parkbench Tutors and narrated by David Hopcroft. For further information about Parkbench Tutors, please visit parkbenchtutors.com. This is the first podcast on measuring and reporting financial position. We will focus first on the balance sheet. Remember that the balance sheet reflects the accounting equation. It is a way of restating the equation to show the position at the end of an accounting period. The equation is assets less liabilities equals equity. Let us start with assets. What do we mean when we talk of assets? The International Accounting Standards Board makes two important points to help us determine what is to be regarded as an asset. Firstly, the resource must be controlled by the entity as a result of a past event. The past event is usually the acquisition of the resource. Secondly, the resource must be expected to yield an economic benefit to the entity in the future. How does an entity control the resource? If it is possible to restrict the use of the resource so that no other entity has use of it, then the resource is controlled. Past events indicate how the resource came to be controlled by the entity. Normally, we are looking at an original purchase or an agreement to acquire the resource. That right to the resource might have come as a result of a merger or takeover of another entity. Future economic benefit means that as a result of using the resource, the entity will gain financially, usually because the entity is used in the production or distribution of goods. We expect cash to be generated in the future. On the balance sheet, you will see that assets are divided up into current or non-current assets. What do we mean by these terms? A current asset is expected to be used either through sale or consumption within the period of the normal operating cycle, which would typically be 12 months. It may be held for longer periods for trading purposes. What comes into this category? The most obvious are cash and inventories for sale, but we also include any trade receivables which we expect to receive from debtors, and any prepayments made for such items as insurance or rent. If we are going to record an asset, then we have to record a value for the asset in monetary terms. The procedure for this is guided by the prudence concept. This demands that we use the net realizable value, which is the selling price of an item less any costs associated with the sale. When it comes to the way in which inventories are valued, there are several methods, including first in, first out, last in, first out, and average cost. We shall look at these in a future podcast. Non-current assets are sometimes referred to as fixed assets, which can be misleading, so current assets is the more frequent term. Broadly speaking, they are any assets that are not current assets. In more specific terms, they represent resources used in production for more than one period and intended to be used on a continuing basis. They are not intended to be sold in the normal course of the business, and they are expected to generate income for the entity in the future. Recording a non-current asset on the balance sheet requires a special procedure. We record assets at historic cost, which means that we include certain other costs to bring the asset into use. We also use the term net book value, which is just the historic cost less the accumulated depreciation. Remember that a book value is not a market value, and the book value should not exceed market value. If we stated the book value as higher than market value, then we would be overstating assets and presenting a false picture on the balance sheet. Let us have a brief look at historic cost. A van is purchased to use in a business, and from the invoice we identify the following amounts. There is a total cost on the invoice, but what is the total we should record as the cost of the asset? We record the purchase price, the registration and the delivery charge because these are the costs of bringing the asset into use. We have not recorded the petrol or the road fund license because these are expenses associated with the use of the asset during the current period. What is meant by depreciation? It is a measure of the cost of using an asset in generating revenue during a particular period. It is considered to be an expense of the period to which it relates. Depreciation entries should follow the matching principle, allocating costs over the lifetime of the asset. the allocation should be fair. So in determining the amount of depreciation, we need to consider the amount of use the asset will have, how long it is expected to be in use, and how will wear and tear affect use, and will technological change affect the use of an asset. The amount of an asset that is depreciated is the cost of the asset that we recorded, less the amount that might be recovered if sold at the end of its use, which is known as the residual value. Depreciation each year is recorded as an expense of the entity. In double entry accounting there must be two entries. One is the expense which affects the profit and loss account, the other is accumulated depreciation, an asset account, which affects the balance sheet. There is more than one method to calculate depreciation, but once a method is chosen for an asset, it must be used for the expected life of an asset. The two most common are straight line depreciation and the reducing balance method, but you should be aware there are other methods. The method chosen can depend on how the asset is used. Even use over the lifetime would indicate the straight line method. An asset that was of greater use in the early years might be depreciated using the reducing balance method. First, we shall consider the straight line method. Cost is written off equally for each accounting period, or a percentage value applied to each year. The residual value must be considered. Consider the purchase of a van for use in a business. Bodgett and Scarpa purchase a new van at an historic cost of $20,000. They expect to use the van for 6 years and to be able to get $2,000 for it as residual value at the end of that time. We will look at how this affects the balance sheet and income statement. The formula we are going to use is cost less expected residual value divided by the expected life of the asset. So we start with the cost of $20,000 less the $2,000 residual value divided by the life of the asset, which we stated would be 6 years. So 20,000 less 2,000 equals 18,000. Divide 18,000 by 6 and we get 3,000. This is the figure we shall use to depreciate the van each year. Take the balance sheet first. We will enter the historic cost, which is 20,000, then enter the accumulated depreciation, which is 3,000, and now we can determine the net book value, which will be 17,000. That completes the entries that relate to the balance sheet. Now we turn to the entries for the income statement. The net profit before we consider depreciation was 34,000. We need to subtract the depreciation for the year from this, so we are going to subtract 3,000. This leaves us with a new figure for net profit of 31,000. Now let us see how we will make the entries in year 2. We already have 3,000 as accumulated depreciation. We are going to add this year's depreciation, another 3,000. This gives a total of 6,000 for accumulated depreciation. Subtract this from the historical cost. We are left with a net book value of 14,000. The net profit for the year was 34,000 before depreciation expense. We only used the figure for this year's expense. Remember, the figure for last year was used for last year's profit and loss entries. So we shall subtract 3,000 to leave us with a new figure for net profit of 31,000. Now let us consider another method for depreciation. This time we will use the reducing balance method, and we shall implement it using the straight line method times 2. So if we take twice 1/6, then we get 1/3 or 33 1/3%. Applying this to year 1, we have 20,000 multiplied by 33 1/3%, 6,660. Now to return to the balance sheet where we have the 20,000 cost of the van entered. The figure for accumulated depreciation will be 6660, which gives us a net book value of 13,340. Next, the income statement. We have 34,000 net profit before depreciation. We subtract the figure of 6,660 to give a new figure for net profit of 27,340. What will happen in year 2? We need to calculate 33 1/3% of the net book value to determine the depreciation. This comes to 4,447, rounding to the nearest whole number. We already had a figure of 6,660 for accumulated depreciation. We need to add the 4,447, giving a total of 11,107 for accumulated depreciation and a net book value of 8,893. For the income statement, we subtract the depreciation expense of 4,447 from the net profit before depreciation to give a new figure for the net profit of 29,553. We're almost there. Now for non-tangible assets, which means anything else that meets the definition of a non-current asset but has no physical substance. The list includes patents, trademarks, licenses and goodwill. Just as our van was depreciated, an intangible is treated in a similar way, but the process is called amortization. What if I'm not sure if the item is an asset? Then ask the basic questions. Will future economic benefit flow into the entity? And does it have a cost that can be measured reliably? Buildings and raw materials clearly meet the test. Advertising does not necessarily mean there will be a future benefit, and certainly very unlikely to have an effect in future years. In the same way, the workforce cannot be seen as having benefit in future years. Since the workforce is fluid, it cannot be clearly seen as under the control of the entity. This ends our first podcast on financial measurement, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For further information about Parkbench Tutors, please visit parkbenchtutors.com.